Hey guys, what's going on? This is Pietro and this is episode number 2 of the Savius video series. Hope you enjoyed the first video. If you're back here with me, it means that you did. Hopefully you've been entertained by my strong Italian accent, which is good. If you're looking for more entertainment, I'm sure you will find some videos of cats playing the piano on the internet. If instead you're interested in learning more about proprietary trading, that's what we're gonna do today. So the menu of the day is discussing prop houses. Okay, so what is a prop? What's a prop? First of all, is a sound you don't want to hear when you're stuck in an elevator full of people. You hear prop. And unless you see oxygen mask falling from above, then you're in trouble. So, but in theory, prop stands, no, so in practice, prop stands for proprietary trading. So proprietary is a word that you cannot say without spitting in your neighbor's face, but it stands for private. So in general, it means that these companies, they trade only private capital, they trade only their own money, so you're not trading third-party capital. That's the main definition. Now, of course, the definition of these companies, as many others in finance, may differ from culture, from Europe and United States, and also from the people you're posing the question to. Personally, I have my own definition of what a prop is. I have my own definition of what an institutional is, so it may not correspond to what you think, but the good part of this video is that eventually that will trigger some reflection and some discussions. Now, if they are private companies and they're trading their own money, what about big trading houses? Some trading houses, the first that comes to my mind is Cargill, that is still, for example, privately owned, and is still a big commodity trading house. Is that a prop house? For some it is. For many others it is not. So what it is this definition is linked to the idea of a small private company operating mostly through market making on niche markets. It's a bit of a narrow definition. For me, the definition is a bit more vague because you can operate on many markets, not necessarily on financial markets. You can also have props which have more directional approaches and instead of more of market making approaches. Now, what is the pro and cons of these companies? Well, let's say that many tend to confuse them with hedge funds, which instead, as you know, trade third-party money. The advantage of having an hedge fund is that, or running an hedge fund, is that you trade with a much larger capital because you trade on behalf of bigger investors, and for that you get a compensation in terms of fees, management fees, and the compensation of performance fees. That means on one side that you have a much more leverage on your capital and you're receiving fees. The fees will keep the lights on when you have big drawdowns and you still have the running costs, etc. The management fees is what they will keep you afloat, at least if you're not performing very poorly for a long period of time. On the other side, of course, it will be brought to operate on markets which are a bit more known. On the other side, you have some more restrictions from the legal standpoint and from the definition of the objective, the target market of your fund, so you won't be able to do everything you want. On the other side, if you're running a prop, you're trading with your own capital, you can pick up the market you want to operate on. You can probably be on those niche markets where being smaller is an advantage compared to be larger, and on the other side you don't get that sort of risk off or leverage reduction that you can get with an hedge fund. Suppose you start with a certain capital X or 100, if you keep on trading and you keep leveraging up your capital, that capital probably compared to your personal fortune will get and will gain a certain percentage that will run an increase, unless you take a cut of the capital at the end of each year, or you continuously reproportion that to your own personal welfare. With the hedge fund, you don't necessarily need to do that constantly because you're managing third-party money. There was, of course, this sort of private trading has always existed. I'm sure that you read plenty of books about the famous traders which became famous probably during the 80s and the 90s. Many of you might have read Market Wizards. Many of you might have seen Trading Places, which is that beautiful movie with Dan Aykroyd and Eddie Murphy. And well, I don't know about where you live, but where I come from, which is Italy, that movie it has become a classic. So everybody watch this on Christmas Eve. If they don't hear it, probably there's gonna be, I don't know, a revolution in Italy, because that's a must-see on the Christmas Eve, so they need to hear it. So what not everybody knows is that movie, let's say, at least the general idea is it originated from a true story, from the story of Richard Dennis, the Prince of the Pit, and a bet he made with his partner, and the whole story of the turtle traders. I don't want to mention this now, I don't want to take too long. We'll probably make a video about this probably in Christmas time, but it's an interesting story. So when each time I look at that movie, and each time I go and read about the incredible stories about these famous traders, many of which were actually trading their own money more than working for, well, in the movie the guys are working for a broker, but many of those famous traders from the 80s, they were trading their own money or trading for from prop houses. And I wonder, will these traders succeed nowadays? Because the market were back then completely different. You had markets like on commodities that used to, after a breakout, they used to go up, limit up maybe for 3-4 days in a row. A lot more directional, a lot less complicated. Traders were a lot more discretional, following, of course, their analytics, but also a bit of gut feeling, following their nose. These days, I have the impression that these days are gone. Now is the era of deep learning, of algo trading, of the quants, on artificial intelligence, of neural networks. The market is surrounded and run by those algos. I believe that more than 70% of the volume on the S&P 500 nowadays runs on algo trading. So the way that the market has changed and evolved is also changing the way the job market for those prop houses which are looking to employ people. Also, that industry has been heavily regulated after the catastrophic years 2008 and what followed afterwards, the crisis of 2009 and 2010, and that has brought to the Dodd-Frank Act of 2010. And it's a famous Volcker rule that basically prevents banks to engage in prop trading. So now, if you ask me, do the banks still have prop trading? Probably they do have their desk. Prop trading nowadays for banks are more identified to what is called agency services, which means that you provide market making services on those markets which are not so liquid. The first that comes to my mind is the market I trade and I come from, which is the freight derivatives. That is in a liquid market, so sometimes if you are a ship owner, you don't necessarily need to open a brokerage account, etc. You just need to buy some insurance. So you have a line with your bank and you ask, okay, can you please put in place a derivative so that I can hedge my asset for 2023, 2024? So the bank gives you a price, the owner receives his coverage, but then it will be this derivative the banks did is on the own bank's balance sheet, and so the bank constantly needs to rebalance that market making services that he's doing for his clients. So it will need to go, the trader sitting at the bank's desk, at the trading desk, will need to go on the market and try to cover himself, possibly gaining a profit from the execution of the deal. So large majority of that trading is mostly agency or execution trading, which means mostly scalping, if you allow me the term, the term scalping the bank's client itself. For some, this is what the prop houses are doing nowadays. So some believe that this trading desk has moved directly from the banks outside, and they're still doing that on niche markets, etc. I believe there's much more than that into prop houses. I think they have their own strategies, their own discretionary trading, as much as discretionary trading, as said before, has moved towards the quant and algorithmic trading. If you ask me, I believe that nowadays the discretionary part in the portfolio of many banks and even many hedge funds is very limited. Let's say that most probably you may have a proportion of 6 analysts and 1 trader execution, and that execution trader has probably a discretionary, the discretionary part of his job is probably very, very small. Now, you're wondering, well, we did say, okay, we discussed what is a prop house, we've seen that is a private company, we know that we are trading our own money, and okay, once more guys, let's face it, fatta la legge trovato l'inganno, we say in Italy. It means that every time there is a regulation, of course, there is a way to go around the regulation. So most probably in the same way there will be a way in which banks can still do a bit of prop trading themselves. At the same way, when you do prop trading, of course, you can still get on board with you 3-4 big private investors that will invest alongside you and maybe be sleeping partner. And let's say that even if the company is private, so in a broad sense, you'll be managing third-party money. It's not what I'm encouraging you to do. What I'm saying is that the regulations are there. The idea is to try and avoid what happened with the financial crisis that keep on repeating themselves unluckily, but at the same time it's very difficult to give definitions of these structures because there is a broad ocean of alternatives, etc, etc. So okay guys, now I believe it's time to go to the core of this show, if you allow me. Fun with flags? No. No, but let's say that we discussed what is the prop houses. We said it's trading private money. Some do market making on niche business, some they have their own algo program, but let's say that from what they used to be, the model that used to be in the 80s or the 90s, these companies have evolved because of the complexity of the market. So some of them have evolved into service companies more than discretionary trading companies. Now, again, I might be wrong in what I say, but I have identified four main models of prop houses. So let's discuss together if I have focused, if I have identified them correctly. Let's start. Okay, I will start by what I call define the trading arcade model. Basically, it's a prop firm that offers mostly sort of service desk for traders. So they will provide premises, so the office, their own. They will provide the software, but more than anything, they will provide leverage. So you will deposit, suppose, a certain amount on an account, suppose $10,000, and they will provide you $200,000 of leverage. Of course, the risk split will be that up to that $10,000, the risk is all yours. Above that, there will be a risk split. But in large majority of cases, if your costs hit your risk limit on the downside, they will probably pull the trigger and say, okay, you reached your risk limit, we are no longer interested in financing you. So of course, as they provide you leverage, they will give you large majority, a kickback of the large majority of the profit you originated, because if you think about it, you've been taking all the risk and they'll be taking off a cut of the profit. So it's a very decent risk reward. On top of that, they will probably charge you the desk fee, the software fee. They will probably charge you commissions, a little extra commission. So altogether, they will be originating a profit by taking the risk, of course, of providing you leverage. Generally speaking, prop houses do not need to be regulated. This in particular, they need to be regulated, I suppose, by the CFTC, because actually what they're doing is a service which is very close to a brokerage firm. So going back to the models, let's say that we have model number 2, which I defined the education model. In this proposed model, the owners normally they try to educate the junior traders, so they will provide, again, if you want, the premises, the offices, and most probably you will go through a period of education where a junior trader will be will be tested and will be taught a trading method, which is probably the core methodology of that proposal. Many of them, they also provide a very peculiar, the proprietary trading software and trading strategy. So in theory, they should provide you with a method, with the means to make money. Of course, you will pay some money for the services you use and for the education you receive. At a certain point, you will be assigned a capital once you have proven to have reached a certain level of understanding of the proprietary strategy. For the best of my knowledge, and I can be wrong, I doubt they will allocate to a certain student or junior trader more capital than what they have received through the sales of services, including software, etc., and of course education. They won't, otherwise it will not make sense in terms of business model. If you ask me, worst case scenario, if you join one of those companies, you walk away with something, because if they provided you education, you have learned something, and also you have the advantage of working within a trading environment with some senior traders for sure. So it's, if you ask me, it's one of those things where maybe 20 years ago, or maybe a bit more, 25 years ago, I would have looked at with interest, unless you have better choices, better options, and that it depends from many other factors. So that is model number 2, education model. Model number 3, that is what I call the video game model. The video game model is probably the same that will identify Savius these days, and many others, some of the most famous proposals between retail traders. For me, it's really like a big video game, because it works. You pay a certain amount upfront. There will be, and you will be tested on a trading simulator with the idea of reaching certain trading targets within certain limits. As I said before, I may agree with you. One of the first polemics, the first observation would be, okay, but I'm a good trader, but I cannot fit that risk model. I totally agree with you. I hear you, I agree with you, but at the same time, as I said in the previous video, these companies need to set down some very tight risk limits, otherwise they just blow up. So the effect of selling these tests, if you have a large enough basis of users, the income should, let's say, at least make it pair or make it even with the risk taken, because you can believe me or not, but the large majority of the traders that actually go live end up blowing the account. So when I used to say, when a trader goes live, for me in the balance sheet that was a minus 3,000, minus 5,000, minus 10,000. I knew that most of the time a trader going live would have meant for me losing money. That is why these companies work, as you can see, that's the reason why I'm here, work through marketing, because you need a large basis, a large statistical sample to rebalance the equation. So let's say that if you ask me, is this useful or not? I would say that compared to trading your own money as a retailer and blow up your own account, which will be $2,000, $3,000, $5,000, if you buy those tests, whatever proposal you pick up, you will be saving money, and you will be forced to learn a methodology. You will be forced by implement some sort of a trading system, some sort of risk management rules. You'll be forced, because otherwise you just keep on blowing. The counter side is that most probably some of these will trigger some of those addictive methodologies, like you keep on going, like if you were in a casino, you keep on buying and buying those tests, like if it was really a video game. It's the so-called PlayStation effect, because this game is fake, this money is fake, so you're not really getting used to trade real money. So you may be very good in trading on the simulator and trade very poorly than when you trade real money. Anyway, going back, this is the video game model, which is let's say the category in which I will say Savius fall. Now one of the next videos I will go a bit more into how the prop houses work. I believe, you know, I can feel the rage around some of these models saying it's a scam, etc. But I believe that when you're sitting on the other side, it's very difficult to be intellectually honest and try to understand that for each test sold there is a cost, a marketing cost, there is of course a personal cost, office cost, data cost, the trading risk, which is not necessarily limited to the risk limit the trader have. Many things could happen. There could be a platform failure. Many things could happen, and you can have a lot more risk than what you expected initially. So it's very difficult to try to understand, also to manage the risk of a bunch of traders that may have potential. So how to exploit the potential without killing the trader, and killing yourself with extra risk is very difficult. Okay, that was the video game model. Let's go for model number 4. Model number 4 is what I call the classic model, but some of you will call it that legit model, because they say that is legitimate. These guys are the only one who actually will hire you, pay your salary and let you trade. Of course they will, if you are a person with the right CV, with the right education background, with the right skills. And what are these famous and well-known and big and professional prop houses looking for? They're not looking for somebody which is frying at McDonald's or which is driving a bus. They are looking for professionals, many of which are these days developers, they are quant traders. Of course there will be space also for a bit of, you know, for some discretionary traders, but most probably with a higher education profile. So the question is, are you one of these very skilled professionals? Then you should apply for this company and you have a chance. If not, possibly one of the 3 previous models we have described fits you better, because you know, if you can choose which sort of trader you want to hire, then you want to pick from the best, which have the right skill to help you develop your company. So guys, to wrap it all up, I would say that finally you should define what is the prop for you. Okay guys, so I believe that it's time to wrap things up. So we've seen what a prop house is, we have seen let's say the arcade model, which provides services including leverage, and that most probably need to be regulated. We have seen the education model, where you pay for education and then one day eventually you will get live, but most probably the risk you'll be allocated will be equal or inferior to the amount you spend for your education, but worst case scenario you walk away with some education. The video game model, a bit like Savius and others, of course is much more accessible, it's much more fun, it costs less, it provides you with some experience and education, but of course it has some pros and cons, so you need to stick with some very strict risk limits, and that might trigger a bit of addictiveness to the sort of PlayStation or gamification of trading, to which I'm not sure I agree 100%. The fourth model is what many of you will define as legitimate or classic model, which is classic model of prop houses that probably live on market making or algo trading, and these guys will probably pay you a good salary and a good chunk of your profit, but at the same time you must be honest with yourself and see if you have the right skills to join them. If you have maybe through network or friends you can get there, but you need higher education, good mathematical skills, you need to be most probably a developer or a quant and not really a discretionary trader. No, if you just take a look, a sneak on LinkedIn and look at what sort of profiles are there on the market, the profile they're looking for is for those sort of let's say of skilled professionals and for specialists in certain markets. Of course, if you are a gas oil trader which has been working on that market for many years, you have a chance with many oil companies. Same if you are a derivative a weather derivative expert as well as an emission trader expert, then maybe you have a chance in that market. Otherwise, you should ask yourself, what is the prop for you? That was terrible, sorry, I said prop 2 times. That was bad, it just came out like this. Anyways guys, I'm not the right person to give you, a recommendation on which one you should join. What I'm saying is that I'm about to find a new prop myself, and if one day eventually I will hire someone, I will more go for the classic model instead of what I used to do when I founded Savius, going for the video game model. Friends used to make fun of me because I funded everyone, all sort of people, from top to bottom, from educators. I also funded a Romanian cleaning lady, which for me, she was talented, but of course they had some imbalance of the education side, so sometimes we couldn't really understand the market properly. But I still believe there are people which have a good nose and a lot of skills that don't have the education. But possibly the real solution is that these guys should get the education, so that prop houses and these retail traders should meet in the middle on a ground where it becomes an advantage for both. And not this relationship between the prop house and the retail traders is unbalanced, one side or the other. Okay guys, that's it for now. I still don't know what kind of video I'm gonna make it next time. I have a few titles in mind. If you have any to suggest, please go on. Your suggestions are more than welcome. I'll see you around. Trade safe. Ciao.